All right. It looks like we've got a few people in the door now. So I might just start ripping into it if that's okay with you, Micah.
Yeah, let's do it.
Cool. Hey, as people come in, I'm just going to kick us off. Hey, I'm Matt. Thanks everyone for joining us today. I'm the head of marketing here at Landlord Studio. For those of you that don't know, we are a property management software built for DIY landlords, people that self-manage. We've helped over 100,000 landlords globally track their income, expenses, stay on top of their taxes, and manage their portfolios without the usual spreadsheet headache. So I spend a lot of time talking to landlords about what's working, what isn't. So today, it's quite exciting for me that we've got someone who's not just talking the talk, but is walking the walk and doing it at scale. So let me tell you a little bit about our guest, Micah White. He is a Chicago-based licensed real estate broker and investor. He's closed over $175 million in deals in just a few years, and he scaled his own portfolio past the $1 million mark in a short amount of time. What I find particularly interesting about Micah here is it's not just about the numbers. The real secret sauce is how he's built his systems around everything. It's not, a constant grind of 60-hour weeks to manage the properties. He's built a sort of really systemized and systematic approach to run a property investment business, his own personal one, where it runs efficiently so he can focus on growth and not the admin. So today, what we're going to do is we're going to get into exactly how he evaluates his deals, that growth side and the systems that let him scale. And then sort of off the back of that, just a little, and we'll touch on the tax strategy that he uses to keep more of that money working for himself. We've got a lot to cover in a short amount of time, so I'm keen to get straight into it. And, at the end, sorry, we will have time for your questions. So drop them into the chat and Shannon will queue them up for us. So let's jump into it. So first things first, Micah. Um, is there anything you wanted to sort of mention about yourself before we jump in, or shall we just get started?
Matt, you had such a great introduction. Made me feel good about myself. So I may just leave it at that. And then if anyone else have any additional questions, I'm happy to answer at the end of the session.
Amazing. Yeah. And what we'll do at the end of the session as well is we'll do a bit of a plug for the different ways you can reach out to Micah. And, if you need any sort of advice or anything like that, he will provide all his contact details there. So let's get started. Micah, you've grown your portfolio to over $1 million and you've evaluated dozens of properties before signing on the dotted line. You know, can you walk us through your decision framework? What are like the 2 to 3 metrics that you absolutely have to see before you even consider a property?
Yeah, I think it really starts with, what are your investment goals, right? And every investor's goals are different. Whether you're looking for cash flow, passive income, right? Or are you looking for appreciation and equity growth over time? You're not necessarily trying to make money every month. Or even, do you have a refinance strategy in mind where you're trying to recycle capital as quickly as possible? Detailing this out for every investor is so important before getting started because you want to then take that buy box and apply that to the properties that you're looking at so you're not necessarily wasting your time. Me personally, I was looking for a combination of cash flow and still am looking for a combination of cash flow and long-term appreciation while getting in at an attractive per unit basis. So really a couple metrics that really stand out to me in my business are cash on cash return, right? This is essentially how much money are you making every month after all expenses divided by the total number, the total dollars invested, right? So if you're making, call it $500 a month, 12 months in a year, that's $6,000 in cash flow a year. If you're in that building for 100,000, all things included, then you're getting a 6% cash on cash return, right? And what we target in our cash return metrics, we're looking for 12% plus. That's what makes the most sense for us in our business relative to some of the other opportunities out there. I would say another metric that we look at is ARV, which is after repair value. So what we try to do in our business is, get in and get out, right? So if we can find a property that we feel is undervalued and we can sort of force appreciation, whether it's through value add rehab or raising rent to market, right? If there's any opportunity in the rent roll, we definitely try to capitalize on that. And that all drives what we look at on the buy side and on the front end. For in layman's terms, if we think something's worth 800 but can buy it at 600, then it may make sense for us to buy, right? And then lastly, a lot of people, well, last but not least, I should say, a lot of people have heard of the 1% rule, right? That's where your gross rents should equate to 1% of the purchase price. This is like a 10-year-old term. It honestly doesn't work in today's market, at least in the United States, Chicago specifically. In some of these high-cost markets where you are able to fetch pretty good rents, 1% is just not, it's not a metric that's used anymore. It's not applicable. I would say, that ratio is now about 0.75 to 0.8 for a rehab product. So if you're looking at a building that essentially is move-in ready, lease ready, you don't have to do any work, you can expect about 0.75 or 0.0075% of that total purchase price that you would get back in gross rents, if that makes sense. So that 1% rule is now 0.75 to 0.8% rule. But yeah, those are just some high-level terms and metrics that we like to use in evaluating deals quickly, because speed kills in this game, right?
Yeah, that's really interesting. You mentioned that you called out that 1% rule. We see that a little bit in our time here
Yeah.
and what we do. And I think it's something that people overlook somewhat when they're evaluating deals, especially, it's kind of a bit more nuanced. Perhaps if you're a first timer, maybe you're sort of buying your first 1 to 2 properties,
Right.
and it's that thing that you sort of build an appreciation for after you've closed it, your first couple at least. So that's really interesting.
Yeah.
We've got a few attendees in the audience here who, are at the beginning of their journey, and maybe they're looking at some of their first deals now. Um, what advice would you have for investors getting into the market in 2026?
Underwrite conservatively. You know, a lot of things can go wrong if you're underwriting too aggressively. You want to have a really good, well thought out backing for how much rent you project at the property, right? Expense ratios. What are taxes going to be after reassessment, right? So in Chicago, we reassess taxes triannually. So every 3 years, we reassess taxes. But a lot of newer investors, will buy a property after, in a reassessment year or the year after a reassessment year and just assume that those property taxes are just going to grow 3 to 5% until the end of their hold, right? When in reality, that on that third year, that assessed value of your property is going to be assessed at, it will likely be reset to your new purchase price. So that's going to be, it could be a 10, 20, 30% jump in tax obligation in that current year, which could really hurt your underwriting if you don't prepare for it. I mean, I have a building here in Chicago. It's a 4-unit building, and we just got our taxes reassessed this year, payable in 2026, and it was a 40% jump, right? So if we weren't expecting that in our initial underwriting phases, it's like you're going to be underwater on that property and likely going to foreclose if you don't figure something else out. So long story short, underwrite conservatively. If you don't know how to, or you aren't confident in your underwriting capabilities, reach out, like learn, try to learn as much as you can before doing it, because in my opinion, the numbers are the first, second, and third most important aspect of any investment. And it's crucial, absolutely crucial to know, because you can make a lot of money in real estate, but you can also lose a lot of money too if you're not prepared. So numbers is number one. And then I would also say, be patient. I like to say stay ready so you don't have to get ready. Whether that's having your teams in place. I think it's really crucial to have your agent lined up, right? There's essentially 5 people, I would say, that are crucial to building your team when you're getting into this game. Those that have already gotten into this game know this, but the newbies who are looking to get their feet wet in 2026 should know that you need a good agent that can help you find these properties. Unless you're directing or sourcing direct off-market deals, which is unlikely. You need a good agent, right? The second person is a lender. You're going to need a lender unless you're buying things all cash. If you're buying things all cash in your first property, give me a shout. I'm happy to get you a greater return than what you're looking at now. We can leverage that. But yeah, you're going to need a good lender. 3, you need a good attorney, right? You're going to have to use an attorney for all of these transactions. 4 is an accountant. For your year-end taxes, it's definitely good to get ahead of that and not get stuck behind the 8 ball. And then lastly, which is important, but if you get your first 4, the last one should be easy to find, whether it's through a reference or someone you may already know. Is it a home inspector or a contractor, right? Things, unless you're buying a brand new property, brand new build, things are likely going to break, toilets or cabinets, what have you. Something's going to need to be fixed, and having someone that you can call to come handle that is going to be really important when you're just getting started.
Okay, that's really good advice. I think that covers off quite a strong foundation, especially for sort of new investors or fresh investors. What kind of advice would you give for people who perhaps were a little bit more mature in their sort of investing journey? So, thinking 3, 5, maybe 10 properties
Yeah,
plus, and that really keen to accelerate in 2026.
yeah.
Um, what kind of advice would you be giving them to help leverage what they've already built to accelerate that?
Yeah, I would say get a good grasp of your liquidity. What capital do you have to deploy in 2026, and work backwards from there. If you have 100,000 to put to work in 2026, I'm a big believer that you shouldn't put that full 100,000 on one deal, and try to divvy it up as much as possible just to diversify. You don't want to leave all your eggs in one basket. Then I would also look into tapping into some of that equity that you may have built in your current properties, right? Whether it's leveraging a HELOC or refinancing, cash out refi to then deploy that tax free money into another property. I would say, if you haven't already, get a good grasp of where you are today as of February 17th, and really understand your liquidity and what you plan to do, and work backwards from there.
Okay, that's really awesome. And I think that ties in kind of nicely into our next section here, which is um, where we're going to get into a little bit around systems. So I'm curious, I'm just going to throw this one out there for the audience who are in here at the moment. What are we using to manage your investments? Is it spreadsheets? Is it software? Is it sort of, your favorite napkin in your favorite diner somewhere? Yeah, throw them into the chat. We're really keen to see. So while you guys do that, I'm going to ask. I have a sneaking suspicion I'm going to preempt some of these questions, and I'm going to make an assumption here and say a few people use spreadsheets. A little bit naughty, but we'll allow it. Um, so, say for instance, spreadsheets as an example. A lot of manual tracking. You've said before that systems are what allow you to scale. Break that down for us. What does like the right system mean? It feels a little bit up in the air, a little bit maybe nebulous. So, in concrete terms, what does a good system look like to you?
Absolutely, and I'm going to plug Landlord Studio here too. I mean, property management software is the number one most important system that we've sort of introduced to our business. With the good property management software, Landlord Studio specifically, you can track accounting, right? You can track your income, your tenants send rent directly through the app software, so there's no checks getting lost in the mail. There's no direct deposits that are being commingled in your personal, your personal bank accounts, right? You want to keep all that separate, and having a good property management software will let you do that. And on top of those two things, you're able to collect maintenance requests all in one app under one house, right? You're not getting tens of hundreds of text messages to your personal phone about this needs to be done, that needs to be done. It's all sort of housed in one area, which we really appreciate. And finally, come tax season, if you're running all this stuff through a good property management software and you're staying on top of your income and you're tracking your expenses, right? You should likely have a clean P&L that you can just hand your accountant and say, hey, this is what's been going on this year. I highly recommend looking at your finances weekly. I have a weekly meeting with my business partner where we sort of break down everything that came in this week or what that we expect this month, and then everything that's gone out, whether that's routine maintenance. We've pegged anything over $200 as a major expense or a high level expense. So we talk about what that was, right? We've had a toilet getting backed up at one of our properties for the last couple months now, where we may need to bring in a plumber, right? So just talking about all of these things, and staying on top of what needs to be fixed. A big, a hidden killer in this game are capital expenditures, right? Deferred maintenance. So that's roof repairs, HVAC, water heaters. Keeping a good pulse on when those are expected to go out, right? Water heaters generally last 10 to 15 years. Roof, you probably have 25 to 30. You don't want to be stuck holding the ball when those things need to be replaced and you have to come out of pocket $15,000. So that's a big hit for a lot of people, myself included. And, staying on top of that and being prepared through the use of these systems and property management software, it's just so important to get ahead of the curve.
For sure. And like sort of put a bow on that, it sounds like, a lot of it revolves around creating a bit of space for yourself as a responsible investor to have that visibility into what your portfolio is doing, right? Day to day, the expenses, maintenance, what have you. And then when you've got that data in place and you've got that financial clarity, it allows you to zoom out as well, right? Like you have a better understanding of how like you can apply some of that financial clarity into some of your investing decisions. So
Exactly.
that's really interesting. And so I guess from your point of view, I have an answer to this, but what do you think in your mind is the key difference between, say, using a spreadsheet to sort of manage these things? Often what we see for people that come through to us is people that use a bit of a mixture of spreadsheets, WhatsApp for, tenant comms and maintenance requests, all that type of good stuff.
Yeah.
And then, so, this manual way of managing your portfolio and software. So, what would you say is the difference between, say, spreadsheets and software?
I would say automation, right? So being able to automate these processes and really, how you should be thinking of it. If you're really trying to scale your portfolio, and I expect everyone that's in this call to be looking to do that at one point in their lives. You want to get to a point where you can step away and sort of start to delegate, right? There's going to come a time where you've built your business enough, you put enough time into where you can start to focus on sort of higher dollar, higher profit activities, whether that's growing the business, what have you. But this day-to-day property management essentially is day-to-day work, right? And if you can automate it, have systems for everything, and using a property management software, you can essentially teach someone else to do it for you and then go on to bigger and better things. Whereas if you're keeping track of a spreadsheet, I personally have done, I'm a spreadsheet guy too, don't get me wrong. So I'm not hating on the spreadsheet. But, there's been so many times where I've forgotten to update this, or I may have an expense that came up that I just failed to remember to put into the spreadsheet, right? But having a property management software and this automated ability, Landlord Studio specifically, you can take pictures of a receipt and it'll upload to your system and tag it as an expense. Like these are all so important when you're trying to move quicker, right? It's a long roundabout way to my answer. Spreadsheets are just too slow.
That kind of ties in quite nicely into our next segment here, which is everyone's favorite topic, obviously, taxes. We can't avoid them, but we can definitely optimize them. So, what tips do you have for us on, staying on top of your taxes throughout the year, so you're not sort of leaving money on the table come, tax season?
Yeah. Number one is get a real estate accountant. Someone that understands what the tax benefits are, and the tax benefits that come with real estate. Accumulated depreciation, cost seg, bonus depreciation, all these terms that a normal accountant who has their CPA, all the requirements they need may not know, right? If you're dealing with real estate, as I am, I highly prefer a real estate focused accountant where that's a majority of their business is in real estate. And then two, I would say you just stay on track of your income and expenses. I mean, really stay on top of them. I've had some bad run-ins with my accountant where he's pretty pissed off at me because I have a lot of missing income and expense items that I just didn't stay on top of, right? I highly recommend doing it weekly or monthly and just reconciling all your accounts, making sure it's way easier to do it real time than go back and do it for the whole year. I promise.
That totally makes sense, right? I like that sort of approach to just a more regular check-in or reviews, I guess, right? And when you're sort of increasing your own personal visibility of the finances year round, it sort of creates less stress or less anxiety when it comes time to, you go make your accountant visit or you go submit
Exactly.
your taxes, etc. So definitely a must do. You mentioned tracking expenses regularly. What kind of specific categories do you think investors miss commonly or under track?
Yeah, top of mind. I think a lot of investors miss capital improvements. They sort of underwrite them and track them as normal expenses when in reality that's not how they should be tracked from an accounting standpoint. Capital improvements are improvements to your building and increasing your depreciable basis. So you want to make sure to separate if you're rehabbing a unit and you spend 15,000 on the rehab, right? You're adding new appliances, new flooring, all these things. It's very important to separate that from your everyday business processes, right? When you're thinking about your accounting, from an accounting perspective, you should split it up into, okay, these are everyday business operations, and these are either growing my business, making my business better through capital improvements, improving the value of my buildings, etc. Right? It's so important to split those up, so when you go to your accountant at the end of the year, you can say, hey, here's what I did, and then let them make the judgment call, right? You want to make their jobs as easy as possible.
One thing we see our investors miss is mileage tracking. I
Yeah,
think people underreport their mileage quite a lot. And when you think about
yeah.
it, that's quite a big deduction every year when you're thinking about every single time you do a visit to the property for a
Mhm.
viewing, maintenance, and inspection. Maybe you've
Yep.
got, another, say, like you're doing a viewing for a vacant property and you run five viewings, that's five trips. And it quickly
Yeah.
adds up, right?
Yep.
And
100%.
so that's something we see as a quick win often in terms of expenses people miss. What's on your
Yeah.
mind for this?
That's so important, and coupled with that are like coffee chats, right, and meals with clients. Like these are all write offs. Like I'm telling you, my every time I go meet a client for a coffee or I treat someone to lunch or dinner or what have you. I mean, 50% of that is deductible, right? So I keep track of that. And, whether you keep a ledger, I like to keep, who I met with, what we talked about, and when it was. That it's as simple as that, right? If you go out to coffee, here's what happened. And, just adding it to your calendar will just help you remember that come tax season. But all of these things are so important to keep track of because they're going to help you come tax season at the end again. So yeah, I've definitely been trying to do a better job of that because I do it so often. I've opened up a separate credit card specifically for doing things with clients, right? Client related dinners, coffee, drinks, whatever, business related expenses. I've got something for exactly that. So yeah, definitely important to separate your expenses. It's like night and day how much it'll help you come tax season.
For sure, for sure. And I guess the last sort of question on this theme here is, we've talked a little bit about organization, but strategic tax planning is sort of a different killer fish, right? So what are
Exactly.
you what are you doing proactively at the moment to sort of reduce your tax liability year over year?
Yeah, I mean, aside from what I just mentioned and being able to, write some of those expenses off, timing your acquisitions is really important. If you've had a really good year, right, and you're headed into Q4, and stepping backwards actually is to always be on the same page as your accountant throughout the year. Let them know what you're doing. Don't try to give them all this information in the last 2 months come tax season, right? You should be talking to your accountant on a quarterly or a monthly basis, whatever works for you. But that being said, timeliness and timing your acquisitions is so important because if you've known that you had a really good first 3 quarters of the year and you're in the green, $100,000 or whatever, you're going to be taxed on that. It may be in your best interest to purchase another property come Q4 so you can depreciate that fully against all that income you've made in Q3 or Q1 through 3. It's really important and that's why it's so important to stay in tune with your accountant and telling them like, hey, what can I do to minimize my tax liability in these last 3 months? They may tell you something different, but that's something that I've found really important. And then on top of that, in terms of just acquisition strategy, I like finding deals that have a low land basis,
Mhm.
right? And what that means is that when you go look at for example, I live in Cook County in Chicago. When you go to the Cook County Property Assessor website and you look at those taxes, it's going to give you an assessed value, call it 100,000, assessed value of the whole building, the whole structure, land included, and then it's going to give you a breakdown of the land assessment, right? So generally 80-20 is pretty common. So 20% of the total assessed value being attributed to land. It's good to keep in mind that land isn't depreciable. So only 80%, so only $80,000 of that building is depreciable because you can't depreciate land. So the more buildings you find that have a lower land basis relative to the building's assessed value, the more you can depreciate. Does that make sense?
Yeah, that's a really interesting insight there. That's not something I've actually thought about before.
Yeah.
As like a sort of little signal as a sort of investment barometer. So I really like that. Um,
Yeah, it can come in handy, right? If you're looking at two buildings, both 100,000, but the land on one is assessed at 50,000 or 50% of the value, versus 20% of the value. That's 50,000 in depreciation versus 80,000 in depreciation that you can capture. So it's really important to know these when you're going into a new acquisition.
cool. No, that's really, really interesting insights. So I know we're sort of coming toward the end here, so we're going to jump into a little bit of Q&A. And so we've covered a lot of ground here. We've talked a little bit about deal analysis, systems, tax strategy. Now I can see Shannon's been collecting everyone's questions, which is awesome. So let's jump in here. So the first question comes in from John here. How do I evaluate properties for rentals or flips? Are there any resources you can send?
Well, isn't that a perfect segue? We've actually got some resources that we can send you. after this call, or even on the call, through a spreadsheet. And then when it comes to flipping, we can send you a rental property calculator. But when it comes to flipping, it's very specific to the flipper because money costs differently to different investors, right? If you're an investor that can get 7.5% money, your spreadsheet's going to be different from an investor who's getting hard money at 12%. It's all very investor specific. But if you want more information about how it applies to you and your investment portfolio, I'm happy to set up a call with you and we can sort of dive into that for you specifically when it comes to flipping.
Cool. And so the next question I have in front of me here is from a new investor, which says, I've heard you talking about the BRRR strategy on the cash flow roadshow. Can you sort of
Yeah.
talk a little bit more about what that is?
Yeah. So the BRRRR strategy, it essentially, so it's BRRRR. So the B stands for buy. That's buying a property, right? Pretty self-explanatory. The first R stands for rehab. The whole strategy, before we dive into the other letters, the whole strategy is essentially getting you to force appreciation and refinance out your money so you can do more deals quicker. So the first R is rehab. The second R is rent. So once you're done rehabbing that building that you purchased, you get it leased up and now it's rented at top of market rents, right? Whatever your building allows. The third R stands for refinance. So what that means is you go back to the bank and say, hey, I bought this building for $100,000. I put in $50,000. This is how much we get in rent now. And this is how much more I think the building should be valued at relative to what I bought it for previously. So the bank's going to be like, okay, I hear you. They're not going to agree with you off the rip. That's just how banks work. It's not going to happen. If they do end up agreeing with you, first ask. I need their contact information. It's very uncommon. But they're going to send out an appraiser to your property and they're going to say, okay, yeah, you know what? That $100,000 property that you put $50,000 in is now worth $200,000. So now you can say, okay, my property that is worth $200,000, you can refinance that at 75% loan to value. So you're all in at $150,000, right? The $100,000 purchase, the $50,000 rehab. Now it's worth $200,000. The bank will give you 75% loan to value on that $200,000. So they'll essentially say, okay, I'll give you 75% of $200,000, which is $150,000. So now you take that $150,000, pay yourself back $50,000 for the rehab, and pay off your original loan of $100,000, and now you essentially have a free property to go on and do another one. Does that make sense?
Sure. That's a really clear explanation. We've got a couple last questions here. The last two are semi-related, so I'll sort of bundle those two together. But the first one I've got in front of me here is, hi Micah, I'm curious to know how you find deals that can provide you with 12% cash on cash return. I find that deals that meet the 1% rule, there is barely any cash flow.
Yeah. You gotta get creative, right? It's all about finding underlying value. In my market specifically in Chicago, there's a lot of mom and pop owners that have owned buildings for 30 years, right? So they haven't necessarily cared to increase rent on an annual basis, right? So those rents could potentially be 20% below market value, right? And that's opportunity to me. So if I can come in at an attractive basis, and whether it's through rehab or just a releasing strategy to get them up to market, that's 20% of value that I just created right there. And that sort of juices your cash on cash return as well if you find that type of opportunity. You really get those higher level of cash on cash returns when there's work to be done, right? If a property's already perfect, it's already rented at top of market, you're probably going to sit in that 6 to 8% cash on cash return range. Me and my business personally, we like the hairier deals. We like to get our hands dirty. So that's sort of how we're able to generate those high cash returns.
Okay, cool. So the next two questions here that we have to wrap up are sort of around software. So Kimberly asks, so software can help you automate and essentially outsource. Um, do I need to have that set up, or even if I'm new to investing and don't have a big portfolio yet? And then the sort of second question I've got here in front of me from Roland is, I use a property manager to collect rent and handle maintenance. She sends me the rent, net of PM fees, maintenance, etc. every month. Would Landlord Studio be useful for me since I'm not currently managing the property myself?
Yeah, for that first question, I would say do what works for you. You know what I mean? If you're only managing 2 units and you're using spreadsheets right now and you feel confident and comfortable doing that, that's fine. But where it becomes a problem is when you grow to maybe 10 units or 20 units and you're trying to use that same spreadsheet. So I'm a big believer of setting up systems while you're small, so you have that foundation already built in order to scale to where you want to go. In terms of that second question, if you have a property manager, they're essentially doing that a lot of that work for you. But having something like Landlord Studio would not be a bad add-on, right? Just so you can track it yourself. I feel that a lot of investors who use property managers, they kind of close their eyes and close their ears and let them handle everything and just take their word as law, right? Here's what came in, here's what went out, here's what everything costs. But in reality, a property manager, there's a markup for everything, right? And you're basically seeing what they allow you to see in a way. So I would definitely say that Landlord Studio could be beneficial for you as well if you wanted to track those things yourself alongside your property manager. Not saying your property manager is wrong, but yeah, I wouldn't say it's bad to track it yourself as well.
Yeah, and I'll just add on to that first one, which is if you're still sort of getting started out and you've only got a couple units or rentals, we actually do have a tier of our landlord studio plan, which is free for up to 3 units. You won't have all the bells and whistles, and some of the things in particular that I would highlight there, the bank feeds. So, connecting your bank account to our bank feed so you can reconcile your transactions in real time, which is obviously particularly useful. Um, but if you have if you fall into that 3 or under unit threshold, I'd recommend just, giving it a trial. I'm not trying to do a hard sell here by any means, but I think you'll be surprised at how easy it is to get set up and get your properties in there.
Absolutely.
I've found that we've made this particular platform with this audience in mind, right? Where we know how precious these assets are to people. We know how difficult it is to learn the complex software, etc. And so, by design, our platform is really simple, really easy to use, but that doesn't mean that the back end complexity isn't there, all the bells and whistles. It's just we want to make sure it's a good experience for people. Um, Cool. So to close out here, we've got a couple versions of Micah's rental deal analyzer available. So one via spreadsheet and one via a online calculator if you prefer. We can jump into that. I will probably need you to walk me through this, Micah, if possible.
Yeah.
So let's talk about this deal analyzer.
Yeah, so this instruction, I mean, you can, the viewers can read this on their own individually. I would say jump to the inputs tab.
Yep.
So if we zoom out a little bit here, you can see everything in blue is essentially what you update, right? So those are the things you change. So if you change the purchase price, so if you type in 700,000 instead of 625 in there for you. Yeah. So this model is fully dynamic. So if you change the purchase price to anything, it's going to automatically update. So now when you scroll down, you'll see that the monthly payment changed based on that new purchase price. So it essentially is going to be very easy for you to just input monthly expenses and everything is done for you. So moving forward to that monthly pro forma tab on the bottom, this is where it takes all that information from the inputs tab and essentially just models it out. I believe this is 10 years long. You can dig into this if you want to, but this is pretty high level in terms of what goes into it. You don't have to touch this at all. It looks complicated. Don't get me wrong. I know, but you don't have to touch this sheet at all. Same with the annual pro forma and the amortization schedule tab. Honestly, I really like the online version that we put together too, Matt. Just for simplicity, where you're inputting the market rents and the purchase price, expenses, etc., and it'll give a clean. Those who are spreadsheet friendly, you'll like this one. But those who just want something quick, maybe that you can do on your phone as you're out touring properties, this next tool will probably be better for you.
Yeah, so what we'll do after this call is we'll send out both formats of the calculator. They're pretty straightforward as long as you've got your sort of base level metrics in hand. So purchase price, appreciable value, all that type of good stuff. We've come to the end of our time here. So I really want to thank you, Micah. You're just a font of really interesting um, insights. I think I learned quite a lot. Obviously, a newbie investor myself, but I'm just going to throw this one out to the audience. So, what's been a key takeaway from today that you might walk away with? I'd be really keen to see if any real value was gained for you guys. And yeah, just once again, thanks again for being so generous with your time and your expertise. I think you've given people quite a good roadmap to follow. They can actually, it's tangible steps they can look at, not just, high level, look for great places sort of advice that you often see online and somewhat infuriates me. um,
Absolutely.
but before we go, I'm really keen to make sure you can plug what you need to plug. So, what's the best place for people to connect with you?
Yeah, yeah. Thanks, man, and thanks again for all those lovely words, man. You're making me blush. I would say the best way to reach me is through social media. It's likely the easiest: Instagram, Facebook, TikTok. It's all at Real Estate with Micah. I answer DMs, so feel free to just shoot me a message there. Thanks for dropping that into the chat, Shannon. And then, so that's probably the easiest way. LinkedIn as well. That's a good one as well.
Cool, yeah. And if you're in the Chicago area, obviously Illinois, any of the surrounds, I think Micah is an expert in definitely that market, but also, nationwide, I would suspect the same principles apply across the board.
Absolutely.
So I'd definitely encourage you to reach out. And so I'm going to do a little plug for Landlord Studio. Hope the audience don't mind here, but if you're new to investing, we've got that free tier for up to 3 properties, and our pro plan starts at $12 a month. So I want to sort of put that into real terms. That's essentially 2 Starbucks coffees a month, and less than your Netflix subscription. So I think it's a pretty worthwhile investment, especially to take care of what is essentially your biggest investment. So, and if you want to keep up to date with everything, more events like this, we'll definitely have Micah back on ongoing. I'm just going to preempt that. But yeah, if you want to keep up to date, follow us on socials at Landlord Studio, across Instagram, LinkedIn, Facebook, wherever you get your social media fix. And feel free to join our landlord community on Facebook as well. We've got a pretty engaged group on Facebook. We're recently just crossed over 3,000 members in that group, and it's just landlords like yourselves who are, supporting themselves, asking questions. We jump in there, we drop that's where we drop all of our product news early, just to, obviously ask our customers and audience what they think and feel, as well as, we jump in as well and answer questions directly. So definitely encourage you guys to join us there. And yeah, any final words, Micah, before we sort of sign off?
I want to thank you guys as well. This has been a great experience. I'm looking forward to sort of keeping this going. And for the viewers, hey, stay dangerous. Stay dangerous. There's a lot of opportunity in 2026. I get yourselves ready. This is going to be a big year.
I love it, mate. I love it. Awesome. So we'll sign off there. I appreciate your time, Micah. I'll get you to stay on the line for a hot sec. But
Yeah.
to the rest of the audience, thank you so much for joining us today. And yeah, stay tuned for more. Catch you guys around.